Elon Musk is about to pull off the biggest financial magic trick in history. SpaceX is targeting a $1.75 trillion IPO valuation. That's more than every American defense contractor combined. More than Coca-Cola, McDonald's, Disney, Nike, and Starbucks, all five added together. So here's the question nobody's asking out loud. Who the bleep is buying this? Because the company lost $5 billion last year, never been profitable on a consolidated basis, and it's about to list at the largest valuation in IPO history. The answer is you, specifically your retirement account, whether you want it to or not. And the reason that's going to happen is because NASDAQ quietly rewrote its own rulebook to guarantee it. But first, you need to understand what SpaceX actually is, because what you think you're buying and what you're actually buying are two very different things. Ask 10 people on the street what SpaceX sells. Most say rockets, a few say Mars. Both are wrong. SpaceX is actually three completely different businesses in a trench coat, and the rocket business, the one everyone pictures, is the least important of the three. Business 1, xAI, the ugly one. A few months ago, SpaceX acquired xAI, Elon's AI lab, in an all-stock deal pricing xAI at $250 billion. You'd assume a $250 billion AI company is at least financially stable, or that the people who built it still work there. Neither is true. xAI was founded by 11 co-founders pulled from DeepMind, OpenAI, Google, and the University of Toronto, a genuine heavyweight team. By 2025, the company was burning over $1 billion a month, and by March of this year, every single one of those 11 co-founders had walked out. Then Elon publicly admitted on his own platform that xAI needed to be rebuilt from the ground up, which is the polite way of saying the CEO of SpaceX paid $250 billion for something that needs to be started from scratch. For context, OpenAI does $24 billion in revenue and is valued at $850 billion. Anthropic does over $3 billion and is valued at $400 billion. xAI, with roughly $1 billion in estimated revenue, was acquired for $250 billion. The market is pricing xAI like it's Emirates. In reality, it's flying Spirit Airlines. Business 2, the rocket company. This is what people picture: launches satellites, cargo to the ISS, NASA crew missions. Generated about $4 billion in revenue last year, roughly a quarter of SpaceX's total. Impressive until you hold it next to a $1.75 trillion valuation. Then it shrinks fast. Business 3, Starlink, the one that actually matters. This is the crown jewel. This is the business paying the bills for everything else. Starlink is a satellite internet provider. Think Comcast, but in space, and somehow better. Over 10,000 satellites in orbit, over 10 million active subscribers across 150 countries. Launched in beta in 2020, now the fastest scaling telecom company in human history. In 2025, Starlink alone brought in $11.4 billion, about 61% of SpaceX's total revenue. But here's the part that actually blows my mind. 2 years ago, Starlink's profit margins were 41%. Today, they're 63%. That's over 20 points of margin expansion in 2 years. The margins aren't just good, they're accelerating. And it's not just home internet. There's a maritime version for ships, an aviation version airlines are rolling out, and a classified defense version called Starshield with direct Pentagon contracts. So here's the actual SpaceX, a satellite internet business that prints cash, a rocket company valued like it already colonized Mars, and, after the February merger, an AI lab burning $1 billion a month. Starlink and rockets together generated about $8 billion in operating profit last year.
Then xAI showed up and torched the party. The consolidated company, SpaceX plus xAI, lost nearly $5 billion on $18.5 billion in revenue, a $1.75 trillion valuation, $5 billion in losses. So again, who is buying this? You are. And this is the real story. On May 1st of this year, NASDAQ quietly adopted something called the Fast Entry Rule. With SpaceX reportedly targeting a June IPO date, the timing is extremely convenient. Here's why it matters. The NASDAQ 100 is the benchmark for tech and growth companies. Over 200 investment products with more than $600 billion in assets track it. The moment your stock gets added to the NASDAQ 100, every fund following that index is automatically forced to buy your stock. That's billions in guaranteed demand built in the second you qualify. But under the old rules, a newly listed company had to wait at least 3 months before joining the index. That waiting period existed for a reason, to give the market time to price the stock properly before passive funds were legally required to pile in. The Fast Entry Rule cuts that waiting period from 3 months to just 15 trading days. 3 months of price discovery compressed into 3 weeks. But that's not the only change. There also used to be a minimum free float requirement. At least 10% of shares had to be available for the public to buy and sell. SpaceX is targeting a float of 4 to 5%. Under the old rules, automatic disqualification. Under the new rules, that minimum is gone entirely. And then there's the hidden multiplier, the one buried in the technical language that almost nobody is talking about. For any company with a free float under 20%, NASDAQ now treats that float as 3 times larger than it actually is. A 4% float gets counted as 12%. A 5% float gets counted as 15%. Put it all together, NASDAQ changed the listing requirement so SpaceX can join with just 5% of the company publicly trading, a level that would have disqualified them 6 months ago. They cut the price discovery window from 3 months to 15 trading days, and they changed the float methodology so ETFs are legally required to treat SpaceX's float as if it were 3 times bigger than it is. Manufactured demand, engineered from the top down. And this isn't only about SpaceX. OpenAI and Anthropic are both reportedly eyeing public listings this year, and both will almost certainly use the same configuration these rules were quietly built for. NASDAQ didn't rewrite the rules for one company. They rewrote them for a class of companies. SpaceX just gets to go first. Here's the part that should make you genuinely uncomfortable. While most IPOs give 5 to 10% of the offering to retail investors, SpaceX is targeting 30% for retail. SpaceX's CFO, Brett Johnson, told a room of bankers on the record that retail will be a critical part of this IPO, bigger than any IPO in history, because retail buyers have been incredibly supportive of Elon for a long time, and they want to recognize that. Translated out of corporate speak, the CFO of SpaceX told a room of bankers they're going to dump 30% of the largest IPO in history onto retail investors, not for price stability, not for long-term shareholder alignment, because they're loyal to Elon. This is how it ends. Insiders sitting on a near-zero cost basis, passive funds and retail investors absorbing those shares at peak valuation. Portfolio manager George Noble said it best, "Your 401k is the exit liquidity." If you hold any U.S. stock index fund in a retirement account, within weeks of the SpaceX listing, you're going to own SpaceX stock. You won't vote on it. You won't choose it. The mechanisms of passive investing will just buy it for you. So here's the honest version of what's happening. SpaceX is 3 businesses that combined lost $5 billion last year, listing at the largest IPO valuation in human history. And we're all going to be buyers within weeks, not because we chose to be, but because the rules were specifically rewritten to manufacture that demand. Passive investing was sold to you as the smart move. Low fees, diversification, set it and forget it. All of that is true, but the part nobody mentioned is that the same mechanism buying the index for you also buys whatever gets added to it, without your input, without anyone asking you. The feature that makes passive investing easy for you is the exact same feature that makes you a guaranteed buyer for anyone who can squeeze their way into the index. And right now, somebody just squeezed their way in. Hit subscribe if you want to actually understand what's happening in markets before it happens to your portfolio.